Listen, I'm about to tell you something your financial advisor won't. Your parents won't. The guy at the bank who sold you that product definitely won't. I don't care. I'm going to tell you anyway. If you're still holding certain assets in 2026, you're not being conservative. You're not being safe. You're watching your wealth evaporate in slow motion and calling it a strategy. And before you get defensive, I've made money. I've lost money. I lost a fortune on a crypto project that went to zero overnight. I've held assets too long and sold assets too early. I've made every mistake you can make with money. The difference? I learned from it. Most people just keep repeating the same mistakes and wondering why they're not getting ahead. Here's my rule. If an asset isn't working for you, it's working against you. Money doesn't sit still. It either grows or it shrinks. And in 2026, with inflation where it's been, with rates where they are, with markets moving the way they're moving, certain assets are actively destroying your wealth. And let me be clear about what 2026 actually looks like. This isn't 2020. Money isn't free anymore. Rates aren't near zero. Insurance costs have exploded. Credit is tighter. AI is disrupting entire industries overnight. If your portfolio was built for a zero-rate world, you're about to feel pain. Here's the damage. Number one, cash sitting in a savings account. I'm going to start with the one that's going to make the most people angry because everyone thinks cash is safe. Everyone thinks having money in the bank is the responsible thing to do. It's not like this, not in 2026. If you have more than 6 months of expenses sitting in a savings account earning 0.5%, you're losing money every single day. You just can't see it because the number in your account isn't going down, but your purchasing power, that's collapsing. Inflation has been running 3 to 4% recently, some years higher. Your savings account is paying you, 0.5%? Maybe 0.01% if you're at one of the big banks that doesn't respect you enough to even pretend. That means you're losing 3% of your purchasing power every year. On $50,000 in savings, that's $1,500 a year you're losing. Not on paper, in real terms. The things you could buy with that money cost more, and your money didn't grow to match. Over 10 years, you're looking at a 5-figure hit in real purchasing power. You didn't lose a penny on paper. You lost it in reality. That's not saving. That's slow motion destruction. And here's what kills me. High yield savings accounts exist. Treasury bills exist. Money market funds exist. You can get competitive yields right now, 4%, 5%, sometimes more on cash. That's nearly as liquid as your savings account. But most people don't bother because they've always had their money at the same bank, in the same account, earning the same nothing. It's not strategy. It's autopilot. Your loyalty is costing you thousands of dollars a year. The bank thanks you for your service. I'm not saying don't have cash. You need an emergency fund. 3 to 6 months of expenses, liquid, accessible, that's non-negotiable. But anything beyond that, sitting in a low-yield savings account isn't an emergency fund. It's a donation to inflation. Move it somewhere it can actually work for you. And don't tell me you're waiting for a dip to invest. You're not timing the market. You're hiding from it. The data is clear. Time in the market beats timing the market. While you're waiting for the perfect moment, your cash is losing 3% a year and the market is compounding without you. The perfect moment was yesterday. The second best moment is today. They didn't get rich letting cash rot. They got rich putting cash to work. Individual stocks you don't actually understand. Be honest with yourself for a second. You bought stocks because someone told you to, because you saw it on Reddit, because your coworker said it was going to moon, because you heard the CEO on a podcast and thought he sounded smart. You don't know what the company actually does. You don't know how they make money. You don't understand their competitive advantage. You couldn't explain their business model to a 10-year-old. Stop. If you can't explain it, you can't own it. You're renting risk. And the lease renews every morning. I've said this 1,000 times and I'll say it again. If you don't understand the business, you have no business owning the stock, period. When you own a stock, you don't understand. You don't know when to buy more. You don't know when to sell. You don't know if bad news is a temporary setback or a permanent problem. You're flying blind. And when it drops 30%, what do? You panic. You sell at the bottom. You lock in your losses. Then you watch it recover without you and feel like an idiot. Or worse, you hold something going to zero because you don't understand that the business is broken. You're sitting there telling yourself it'll come back while the company's bleeding cash and the insiders are selling. I see portfolios all the time full of stocks people bought on tips. A little bit of this, a little bit of that, no thesis, no conviction, just a collection of lottery tickets dressed up as an investment strategy. Here's what I tell people. If you can't explain in 2 sentences why you own a stock and what would make you sell it, you shouldn't own it. Sell it. Put the money in an index fund. Stop pretending you're a stock picker when you're really just hoping. And here's another rule. If you own more than 10 individual stocks and you're not a professional, you're not diversified. You're confused. Pick your best 5 ideas or just buy the index. A portfolio of 20 random picks isn't strategy. It's noise. The market doesn't reward hope. It rewards understanding. And if you don't have understanding, at least have the humility to buy the whole market instead of pretending you can beat it. Crypto you bought because someone told you to. I already know what you're holding. A bag of something down 80% that you're afraid to look at. Look, I'm not anti-crypto. I've invested in crypto. I've made money in crypto. I also lost big when a project I was in collapsed overnight. One day it was worth millions. The next day it was worth 0. Gone. That taught me something. Crypto isn't an investment for most people. It's speculation. And there's a difference. An investment has cash flows. It produces something. You can value it based on what it generates. A stock represents ownership in a company that makes money. A bond pays you interest. Real estate generates rent. Most crypto produces nothing. Its value is based entirely on what someone else will pay for it tomorrow. That's not investing. That's the greater fool theory with a blockchain wrapper. If you bought Bitcoin or Ethereum because you actually understand the technology, you believe in the use case, and you're prepared to lose everything, fine. That's a calculated bet. I can respect that. But if you bought some random altcoin because a guy on YouTube said it was going to 100x, if you bought a meme coin because it was funny, if you're holding bags of something that's down 80% and you're telling yourself it'll come back, you're not an investor. You got sold. Here's the rule. If crypto is more than 5% of your net worth, you're not investing. You're gambling. And if you can't explain what the token actually does in 1 sentence, you don't own an asset. You own a lottery ticket. If you want exposure, fine, treat it like venture risk and size it like venture risk. Most venture bets go to 0. Act accordingly. And if that makes you mad, good. It means you're overexposed. And here's the brutal truth. Most of that stuff is never coming back. The projects are dead. The developers moved on. The liquidity is gone. You're holding a token for a game nobody plays or a protocol nobody uses. Sell it. Take the loss. Learn the lesson. Put what's left into something that actually makes sense. High-fee mutual funds, your advisor sold you. Your financial advisor robbed you. He did it legally. He did it with a smile, and you thanked him for it. If you're paying more than 0.5% in fees on a mutual fund, that's a red flag. Under 0.2% is where you want to live. Anything higher better be proven, and it never is. And most people don't even know what they're paying because the fees are hidden in the fine print. Let me explain how this works. The average actively managed mutual fund charges about 1% in fees. Some charge 1.5%, some charge more. That doesn't sound like a lot, right? It's just 1%. Over 30 years, that 1% costs you 1/3 of your wealth. I'm not exaggerating. Let me show you the math. You invest $10,000 a year for 30 years. The market returns 10%. With a 0.1% fee index fund, you end up with about $1.74 million. With a 1% fee mutual fund, you end up with about $1.32 million. That's a $420,000 difference. On the same contributions in the same market, you just gave $420,000 to a fund manager who statistically probably didn't even beat the index. Because here's the other thing nobody tells you. Most actively managed funds underperform their benchmark index over long periods. After fees, the majority of professional stock pickers lose to a simple index fund you could buy yourself for almost nothing. Your financial advisor recommended these funds because they pay him a commission. He gets paid when you buy. He doesn't get paid to put you in a low-cost index fund. The incentives are broken, and you're the one paying for it. If you have money in any fund charging more than 0.5%, look at moving it and aim for under 0.2%. Vanguard, Fidelity, Schwab. They all have index funds with fees so low they round to zero. The S&P 500 doesn't care which fund you use to buy it, but your future self will care about that $420,000. Your financial advisor gets paid when you overpay. That should tell you everything. And this one is personal, your own company's stock. Let me tell you about a pattern I've seen destroy people. If more than 10% of your net worth is in your employer's stock, you're taking a massive unnecessary risk. And most people have way more than 10%. Think about it. Your salary comes from this company. Your health insurance comes from this company. Your retirement contributions often go into this company's stock. Your entire financial life is tied to one entity. If that company struggles, you don't just lose stock value. You might lose your job at the same time. When you need money most, your stock is worth the least. I knew a guy, smart engineer, 20 years at a tech company, had 70% of his retirement in company stock because he believed in the mission. Company got disrupted. Stock dropped 60%. Then the layoffs came. He lost his job and watched his retirement evaporate in the same quarter. He wasn't stupid. He was loyal. And loyalty without diversification is just risk you can't see. This pattern repeats every economic cycle. It happened at Enron. It happened at Lehman. It happens at companies you've never heard of because they don't exist anymore. And here's the psychological trap. You think you know your company. You see it from the inside. You believe in the mission. You think you have an edge. You don't. You know what's happening in your department. You don't know what's happening in the CFO's office. You don't see the balance sheet issues, the customer concentration risks, the competitive threats that keep executives up at night. Insider knowledge makes you overconfident, not informed. If your company gives you stock, great, take it, but sell it regularly and diversify. Don't let loyalty destroy your financial security. The company won't take care of you if things go bad. They'll lay you off and wish you well. Diversification isn't disloyalty, it's intelligence. And here's one that surprises people. Bonds at the wrong time. If you're buying long duration bonds because you think bonds are safe, you don't understand bonds. Safety isn't the label. Safety is the math. Here's what most people get wrong. When interest rates go up, bond values go down. If you bought a 10-year bond paying 3% and rates rise to 5%, your bond is now worth less because nobody wants to buy 3% when they can get 5%. We just lived through this. In 2022, long-term bonds had one of their worst years in history. The TLT, which holds 20-year treasuries, dropped over 30%. People who thought they were being safe lost a third of their money. Here's the rule. If your bond fund has a duration over 7 years and you don't know what duration means, you're not investing, you're guessing. Duration measures how sensitive your bonds are to rate changes. The higher the number, the more you lose when rates rise. Short-term bonds and treasuries under 2 years, fine. You know what you're getting. Long duration bonds in a volatile rate environment, that's for professionals with a thesis, not regular people looking for safety. If you're near retirement, different game. You're buying stability, not growth. If you're young, long duration bonds are a bad trade. Big risk, small reward. And if rates stay higher longer, you're locked into mediocre yield while inflation keeps chewing. And here's the opportunity cost. The stock market has historically returned 10% a year. Bonds are paying 4 to 5% right now. Over 20 years, that difference is enormous. Know what you own and why you own it. Last one, real estate in markets that are dying. Ask yourself one question. Is your market gaining people or losing them? I'm not going to name cities because the point isn't the city. It's the signals. If you own real estate in a market that's losing population, losing jobs, and losing value, you need to take a hard look at what you're holding. Here are the red flags. As a rule of thumb, watch for population declining year over year, job losses in the primary industry, insurance costs spiking faster than you can raise rents, rent growth flat or negative, and homes sitting on the market for months with no buyers. Stack a few of those together and you're not holding an asset, you're holding a liability. Real estate is not liquid. You can't sell it in a day. You can't sell part of it. When a market turns, you're stuck watching your equity evaporate while you wait for a buyer who may never come. I've seen people hold on to properties in declining cities for years, watching the value drop, paying property taxes, paying maintenance, waiting for a turnaround that never happens. They would have been better off selling at a loss and putting the money into something that actually grows. Sunk cost fallacy kills real estate investors. They think, I can't sell now, I'd lose money. So they hold and they lose more money every year for years. If your property is in a market with population decline, job losses, rising insurance costs, falling rents, no demand drivers, you're not holding an asset. You're holding a liability that's dressed up in a property tax bill. Sell it, take the hit, move on. Your future self will thank you. And here's why most of you won't do any of this. Let me be real with you for a second. Most of you know you're holding assets you shouldn't. You know that savings account is earning nothing. You know that stock you bought on a tip was a mistake. You know those fees are too high. But you don't act. Why? Because selling feels like admitting you were wrong. Because moving money feels risky even when not moving it is riskier. Because you've always done it this way and change is uncomfortable. You're not making financial decisions. You're making emotional decisions and calling them financial. The guy who won't sell his company stock, not loyalty, fear. The woman keeping cash at 0.01%, not safety, avoidance. The investor holding a dead altcoin, not patience. Denial. Every one of these is ego protection disguised as strategy. The market doesn't care about your ego. It doesn't care about your comfort zone. It doesn't care whether you feel ready to make a change. It just compounds in whichever direction your choices point it. And here's the asset nobody thinks about, time. Here's the one that's going to make some of you really uncomfortable. The most valuable asset you have isn't money, it's time. And most of you are wasting it in ways that are costing you a fortune. Every year you don't invest is a year of compounding you never get back. Every year you spend in a dead-end job is a year you're not building skills that could double your income. Every year you stay in a city with no opportunity is the year you're not building the network that creates wealth. I see people in their 20 seconds and 30 seconds who are saving money by not investing in themselves. They won't spend $500 on a course that could teach them a valuable skill. They won't move to a city with better opportunities because moving is expensive. They won't switch jobs because the process is uncomfortable. They're being penny wise and pound foolish. They're protecting small amounts of money while wasting the one asset they can't get back. If you're young, your biggest investment should be in yourself. Skills, network, experience, the things that increase your earning power for the next 40 years. A 20% increase in income compounded over a career is worth millions. That's not an exaggeration. That's math. Stop treating yourself like a liability. Start treating yourself like the asset you actually are. So what should you actually hold? Let me be constructive. I've told you what to get rid of. Here's what to own instead. A real emergency fund. 3 to 6 months of expenses in a high yield account earning real yield, not 0.5%. Broad market index funds, S&P 500, total market, low fees, diversified, boring, effective. Your own skills. Never stop learning. The best investment is one that increases your earning power. Optionality, cash reserves, career flexibility, the ability to move on opportunities. The people who build wealth can say yes when everyone else is stuck. That's it. It's not complicated. It's just boring. And most people would rather gamble on exciting assets than get rich slowly on boring ones. Here's your 30-minute portfolio audit. Do this Monday. Pull up every account. Brokerage, 401k, IRA, that random Coinbase wallet you forgot about, all of it. Write down every holding, every single one. Circle anything you can't explain in 2 sentences. Those get sold. Look up the fee on every fund. Anything over 0.5%, flag it. Calculate your concentration. What percentage is in your employer's stock? What percentage is in crypto? What percentage is in any single position? Here's your checklist. Cash beyond 6 months emergency fund earning less than 4%, move it. Any stock you can't explain, sell it. Crypto over 5% of net worth, trim it. Employer stock over 10%, diversify. Fund fees over 0.5%, red flag. Find something under 0.2%. Bonds with duration over 7 and you're under 50, rethink it. Set up automatic contributions to your index funds, same day every month. Before you can spend it, that's the audit. 30 minutes, do it this week. Here's what I'd tell you if you were my kid. Look at every asset you own. Ask yourself, is this making me money or is it just sitting there? Is this growing or shrinking in real terms? Do I understand this or am I just hoping? If you can't answer those questions clearly, you probably shouldn't own it. I showed you what to look for. I showed you the math. I showed you why it matters. The question is whether you'll actually do something about it. Most people won't. They'll watch this video, nod along, and change nothing. 6 months from now, they'll still have cash, earning nothing, stocks they don't understand, and high-fee funds that are bleeding them dry. Don't be most people. Audit your portfolio this week, not next month, this week. If your portfolio is built on comfort instead of math, you're not invested. You're exposed. Comfort is expensive. Math is cheap. If you don't change the numbers are going to change your life. Math doesn't negotiate.